Very good evening, everyone. I hope you all are doing well. So, as I have discussed with you in today's current affairs session only, that there are certain guidelines released by SEBI regarding REITs and InvITs to provide them alternate sources of funding, etc., and also regarding securitization. So these guidelines are there. We are going to discuss these concepts. It will be useful for you for all the examinations, also particularly for the upcoming SEBI interview, right? So these are conceptual things. That's why it takes time, and that's why I didn't incorporate it into the CAQ&A format, but separately we are discussing it, and the questions, they have been incorporated in the CA session which I have conducted today. Okay, so you can go and read the questions. Now this is the explanation. These are the guidelines. Let's see what is there. So first thing which we have here is, you can see here that, okay, so you can find this thing in 1st to 4th November PDF uploaded into your current affairs paid courses. Okay, you can find this information. It is clearly mentioned over there in your 1st to 4th November content given to you. All right, and I hope the audio and video is all good. Can anyone please let me know before I begin with the discussion? It would be better if you can confirm, is the audio video all good? Anyone? Okay, then let me begin with this. So SEBI has proposed key changes for REITs and InvITs to enhance market flexibility and investor protection. So let's see what are these changes. First of all, I hope you all must be knowing what are these REITs and InvITs, but even if someone does not know that, so let's discuss about REITs and InvITs. These are very, very important concepts, also very important part of your finance syllabus of RBI Grade B, right? Clearly audible? All right. So what are REITs and InvITs? First of all, let's discuss that. If you have any confusion regarding that, it would get clear. So you have these REITs and InvITs. Okay, these are basically the investment vehicles. They pool the investors' money and they invest them into REITs, real estate investment trust, so real estate properties, and InvITs, infrastructure trust, infrastructure based properties or infrastructure based capital, right? So this is a way where investors can get benefit out of real estate properties or infrastructure projects without actually owning them. This is the basic concept. I hope you have understood that, right? So say you have one REIT established over here. All right, this is the fund. Now there are different investors. They have pooled their money into this REIT, right? It invests into a lot of, say, real estate properties. Lot of real estate properties. Okay, so don't go on the diagrams, okay, just for illustration to make you understand. I know they do not reflect the exact ones. So these are, say, properties invested, and whatever return comes over here from this investment, it gets distributed. Right? This is how these REITs and InvITs, they work. I hope this is clear. So these are the investors. These are investors. These investors have pooled money. The REITs have collected this money, pooled this money, and invested into real estate properties, and the return will be distributed. Okay, tell me about the concept. Have you got the concept? Right? So this is how they work. Now REITs and InvITs, they provide you a good option to invest and earn returns. I hope the REITs and InvITs, these investment vehicles, are clear. Yes or no? Tell me quickly so that I can proceed further with the guidelines. All right. This is the thing. Now moving back to the content. What are the changes? What are the changes in the guidelines? Since the basic is clear. So now first thing, broadly if you see the aim, it wants to improve the business flexibility of these REITs and invests. First thing is interest rate derivatives. So this is important, remember. SEBI has proposed allowing REITs and InvITs to use interest rate derivative for hedging purposes. So SEBI has proposed that it is going to allow REITs as well as InvITs, these investment vehicles, that they can use interest rate derivatives to secure their investments or to hedge against any market based fluctuation in the interest rate. What does that mean? Now this is going to be very important for REITs and InvITs. So first you need to understand what are these interest rate derivatives. So one example which we can have is interest rate swap, right? I have explained, I think, the interest rate swap in some previous classes as well. So first you need to understand what is interest rate swap, then you will be able to understand this guideline which SEBI is proposing, that now REITs and InvITs can use these interest rate swaps to hedge against any future risks. What are these swaps? See, interest rate swap, one kind of interest rate derivative which you can have. What happens is they are particularly popular in international market but also popular in the domestic one. Wherever you want to reduce the chances of market based fluctuation, you want to secure the future investments, right? So interest rate swap, these are agreements between two companies or parties to exchange their interest rate liabilities. Are you getting my point? I'm giving you an example that will help you understand it better. Okay. So this is company A and company B. Let's take an international scenario only because that will make you understand why they are important, right? Now what happens is, I'm taking the international scenario because it highlights the significance of interest rate swap. Suppose there is this company A from USA and this company B from Japan, right? It has a loan outstanding from bank XYZ in USA, say $8 billion, or say some loan with the interest of 8%. Forget about it. Okay. It has a fixed interest based loan. Company A in US has a fixed interest rate based loan which is fixed at 8%. Okay. Whatever the amount is. Company B in Japan, situated in Japan, has a floating rate loan, right? That keeps on changing. Suppose presently it is say 9%. Okay, presently it is 9%. Now what happens? They exchange this. Why they exchange this? This liability is from say bank ABC in Japan only, of company B, and this is from XYZ in US. Now what happens if company A wants to expand its business in other countries, say Japan? It requires loan, right? But then taking loan in Japanese yen might be more costlier than the US dollars. Similar happens with the company B. If say the Japan based company wants to expand its base in US, wants to take loan, might be costlier or will be costlier in terms of US dollars. So what they do is, rather than going and buying loan, going and applying for loan in respective countries, they exchange this, right? So the interest rate also gets extended. This is interest rate swap, and this happens in the domestic market as well. Now who gets benefited out of it, who does not? Suppose this is fixed and this is floating, as I told you. It helps them secure for or hedge against future market based risks. So first example as I took of 8%, and here we have this 9%. Now let's see if this has increased to 9%, right? They have exchanged this. That means company A has liability towards US Bank XYZ of 8%, but since they have exchanged this, so company A is going to pay additional to this company B. And when it decreases, say suppose it has decreased to 6%, it has decreased to 6%. This liability was exchanged by company B from company A. So although it was floating, it has reduced, but still this company will be in loss. This party will be in loss. Why? Because as per the floating rate, it has to pay only 6%, but because this was exchanged in the swap, it has a liability of 8%, exchange from A. So additional 2% is the loss it has to incur. These kind of swaps are there. But who gets benefited? It gets benefited when the floating rate increases. So one party will be at loss and one party will be at profit. That depends on the situation, whether it is increasing or decreasing. These kind of interest rate swaps are common. I hope you have understood the concept of interest rate swap. Everyone, yes or no? Tell me. Yes, Nitin, Shreya, Alex. Understood the concept? Right? So now the guideline you will be able to understand. Guideline says that SEBI is proposing, is planning to allow REITs and InvITs also to engage into these interest rate swaps. Right? Now it will help in hedging against future securities. Yes, it is only interest rate swap we are talking about, not the currency swap. See, one party will be at benefit, one party will be at profit, right? So you have to take certain kind of risk. Okay, one more thing. The floating rate wali party B of Japan, was it profit when the rate increased, right? So this way you can hedge. You have to basically take certain risk in order to avoid the risk. Because one interest rate is fixed and one is floating. So that depends on the changing, the floating one, who will get benefited. I have explained you both the scenarios. If it increases, who gets benefited, and if it falls, who gets benefited. Getting my point? Also, one more advantage, as I told you, that it is more popular in the international market scenario because they are easy to take loan. They are easy as a loan in order to expand your business, for example, rather than going to the country itself and then applying for loan in their own respective currency, right? So a lot of other benefits are also there. Now this is the guideline. REITs and InvITs can also use these interest rate swaps. One party will be at benefit at one point of time, right? So interest rate derivatives, SEBI has proposed this thing. Remember, they can use this. Next guideline is liquid fund investments. Now, this says that REITs, InvITs and small and medium REITs. What are these small and medium REITs? Small and medium REITs are basically those REITs who manage the small and medium sized real estate projects or assets, who hold the small and medium sized real estate projects. So this is again very important. REITs, InvITs and small medium REITs can now invest up to 20% of their corpus in liquid funds. SEBI has allowed them to invest up to 20% of their corpus in liquid funds. Now, what are these liquid funds? You can consider them like a mutual fund only. So, liquid funds, they basically invest into particularly short-term securities, particularly money market instruments. Because money market instruments, they have a short-term maturity. So, generally, they invest into more liquid, short-term liquid instruments. Now, this is going to provide flexibility in managing the liquidity requirements for REITs and InvITs, okay, and reduce the impact of any fluctuation. So, remember the rate It is 20%, right? 20% of their corpus in liquid funds they can invest. Like you have the government securities, you have the certificate of deposits, commercial papers, right? All these money market instruments, these are more liquid. So liquid funds, they invest into these debt funds or debt instruments, but particularly for short term. I hope this is clear. So we have seen this one and this one. Then next one is Nomination and Remuneration Committee. So the composition and functioning of NRC for REITs and InvITs have been aligned with the listed companies. This is again going to be important. The composition and functioning of NRC, Nomination and Remuneration Committee. What does a Nomination and Remuneration Committee does? So a Nomination and Remuneration Committee basically tries to search out the best, say, directors. So nomination and remuneration they decide upon. But this composition functioning of NRC for REITs and InvITs, they have been aligned with that of the listed companies now. What does that mean? Previously, the NRC for REITs and InvITs, they were required to consist solely of the independent directors. But now, new proposal says that a mix of independent and non-executive directors, which is similar to the guidelines of listed companies given by SEBI, can be there for REITs and InvITs. So, broadening the scope of NRC for REITs and InvITs. This is again the next guideline. Clear? Okay. So you can have a mix of independent and non-executive directors, which is similar to the guidelines for listed companies under the SEBI. More flexibility in the composition of NRC will be provided via this. I hope this is clear, right? So change in the NRC composition, or we can better call it alignment of NRC composition with that of the guidelines for listed companies. This is clear. Next thing, common infrastructure. Common infrastructure. Under this, SEBI has proposed to define common infrastructure to include facilities like power plants, water treatment systems that serve multiple REIT assets. So now, power plants or the common infrastructure will include these power plants and water treatment systems as well for the REIT assets, for the purpose of REIT assets. So the common infrastructure which come under the REIT assets holding, they can also include these power plants, water treatment systems, etc. This is the common infrastructure definition expansion. Is this clear? Tell me, are you getting all these points or no? Yes or no? This is clear, right? So extension of this definition, and then NRC wala thing we have seen. Next thing is quarterly results. Quarterly results. So InvITs will now be required to disclose quarterly results, ensuring greater transparency and accountability. Quarterly data they have to show, quarterly results they have to show, so that the process becomes more transparent. Right? This is general guideline. Then there is something regarding the lock-in period. The lock-in period for the sponsor units is to be extended. Now, up to what time it has to be extended is still not mentioned. It will be specified, but they have proposed that this lock-in period will be extended. Now, what is this lock-in period for sponsors? Sponsors and originators. So, sponsors of these REITs and InvITs, they are basically the entities or units who manage this entire investment vehicle, right? So these sponsors, they should have a lock-in period which has to be extended according to the guideline. Why do they want to extend this lock-in period? To ensure continued commitment and alignment of interest. That means that if sponsors, they have a lock-in period extended, they will be responsible, they will be reliable. From an investor's point of view, if you think, they will be more committed to the management of the assets. This is the main purpose. They will be more committed to the management of the assets, right? but the exact duration has not been specified so far. So it will be specified. This will be for sponsors who manage all these investment funds and they manage the processes, oversee the processes, etc. Okay, so this was about REITs and InvITs. I hope all these guidelines are clear. We have seen all of them. Remember the 20% wala figure. Okay. Now, moving on to the next guideline, which is there. It is regarding securitization. New rules for securitization. Now, what is securitization? Securitization is generally first of all, you need to understand the securitization process. Securitization process mein you have a different kind of loans. For example, assets, they are brought together. Now, particularly if you see securitization is used for the purpose of the non-performing assets, right? If the assets are performing, then there is no use of securitizing, or say not so much significance. So securitization is particularly used for the non-performing assets. So all those loans, they are clubbed together. In securitization, you have all those bad loans, for example, clubbed together. Okay, all the bad loans clubbed together, and then they are formed as different units which different investors they buy. Okay, so suppose these loans, they were purchased by an ARC, asset reconstruction company. You know how ARC works under the SARFAESI Act, right? So ARCs, suppose they have bought all these bad loans, they have converted them into investment units. They will be purchased by different investors. This way, investor gives them some money, so some part of the bad loan gets secured, some part gets recovered. Who benefits? ARC benefits, it keeps its portion. Investors benefit because they get the return over this investment. This is the securitization process, particularly popular. Okay, I hope this is clear. Tell me, securitization is clear? This is the process. I hope it is clear. So now the guidelines are in front of you. First thing, minimum ticket size. So ticket size, basically minimum investment amount which you have to commit as an investor when you are purchasing an investment instrument, right? So minimum ticket size, minimum investment. In this case, SEBI has proposed that the minimum investment in securitized products, these securitized products which are created out of the securitization process by both the RBI regulated originators and unregulated entities like private companies, etc., is to be at least 1 crore. What does that mean? Originators are basically who create these securitized assets, right? Say banks, financial institutions. So originators who create these securitized assets, right? So first guideline which we have, it says that minimum investment by whether you are regulated entity or non-regulated entity is set as 1 crore. So remember this figure, rupees 1 crore. So in this securitization process, if you are investing into the securitized product, it has to be at least 1 crore. This is first thing. Next, limitation on number of investors. Again, this is very, very important. So proposal limits the number of investors for privately placed securitized or SDIs to a maximum of 200. If you see, this guideline says that if number of investors are there, if you are privately placing it, it is not a public offer, for example, if it is not a public offer, if it is privately placed, maximum number of investors has been kept at 200. Maximum number of investors has been kept at 200. If it goes beyond that, that has to be a public offer. I hope this is clear, right? So if an issuer, intends to raise funds from more than 200 investors, you want to raise fund from, then the issuance must be reclassified as a public offer. And you all know that when it is a public offer, it comes under more stricter regulation or scrutiny. This is the thing. So remember, limitation on number of investors at 200. I hope this is again clear. Next, then public offer regulation. So the rules stipulated that the public offer, in case of more than 200 number of investors, must remain open for a minimum of 3 days and maximum of 10 days. Remember this. This public offer ke liye they have set this opening window. Minimum how many days? 3 days, and maximum it can be open for 10 days. So remember, minimum 3 and maximum 10. Minimum 3 and maximum 10 for this public offer, right? Minimum 3 and maximum 10. Next guideline is dematerialization of instrument. All these securitized instruments, debt instruments, the SDIs, they have to be, the transaction has to be electronically only. This is the guideline. The proposal mandates that securitized debt instruments, they must be issued and transferred exclusively in dematerialized form. Exclusively in demat form or dematerialized form. That means the entire process of transaction has to be settled down electronically only. Right? Then you have risk retention requirement as well. SEBI has said that the originators who created this securitized asset, they must retain at least 10% of the securitized pool. They have to retain the risk. Now this is again very important. Why do they have to retain the risk? So at least the original value, when the pool has been created, that value, us value ka 10% you have to retain. 10%. Why? So that you remain liable to it, right? You remain responsible for the performance and management of the asset. Getting this point? This thing. Next, another part of it, if the receivables are there, say whatever, you have certain amount outstanding from a buyer, right? Or from an investor. So if you have certain receivables outstanding for maturity up to 24 months, you have certain receivables outstanding for maturity up to 2 years or 24 months, in that case, this retention requirement is lowered to 5%. Then you can retain only up to 5% of the original value of the securitized asset. But if it is less than that, you have to retain at least 10%. I hope the purpose is clear. I have explained it to you because it sets out a positive note for the investor as well. Investor believes that, okay, then the originator will be responsibly managing the asset because it is also liable to the losses. 10% you have to retain the risk. I hope this is clear. Then next you have minimum holding period. So SEBI plans to implement a minimum holding period for the underlying receivables as well. Now this has not been specified, but it will be there again so that the originators maintain an interest in the assets. As we have discussed again and again, the broader perspective or the purpose is that the originators should maintain an interest in that, should be liable for it, right? Then optional cleanup call. So proposal also includes an optional cleanup call. This is not mandatory, this is optional. What is this cleanup call feature? That it allows originators to repurchase up to 10% of the original value of securitized asset. When you feel that the underlying assets you are having are falling, say, will not be sufficient to maintain liquidity, falling short of liquidity or any other condition, you want to repurchase to stabilize the value of that asset. Now you want to repurchase it, you can repurchase it. So this is an optional cleanup call. but that has to be capped at 10%. You can repurchase only up to 10% of the original value of the securitized assets. Clear? Okay. This will better help them manage the assets and liquidity, and it will give a positive note to the investors as well. Okay. That in case some fluctuations happen, they have this opportunity to repurchase up to 10% of the original value. It will be better managing the assets, basically, overall purpose. Just understand the layman purpose, okay? Then liquidity facilities. Liquidity facilities, it is a general guideline says that to address the timing mismatch, in cash flows, SEBI has mandated that liquidity facilities will be provided. That liquidity facility is not a separate window. It simply means that there should be options for the originators to meet any uncertain mismatch in the cash outflow and inflow, so that the interest of the originator and that of the investor does not get hurt. Simple, right? So this is a normal guideline. Then we have updated definition of the underlying assets. This is important. It has also proposed to revise the definition of or debt or receivables, okay, limiting eligible underlying assets. So what are the eligible underlying assets which can be used for the securitization purpose? It has clearly set out the definitions of it. So you have listed debt securities. These four names you remember. These four names you remember exactly. These are the part of new revised definition of debt receivables to be qualified for securitization process. Listed debt security, say bonds, etc., government bonds, corporate bonds, listed, they are actively traded on the recognized stock exchanges, and debt securities, say bond, right, bonds, etc. Accepted trade receivables, say you have certain trade receivables outstanding from a borrower, that can also be there. Rental incomes, equipment leases, you have rented out certain property or instrument, that fund can also be utilized for securitization process. Equipment leases, you have leased out certain, say, industrial equipments, machinery, etc. That can also be utilized for securitization process. So these are receivables or the debt instruments eligible for the securitization process. Remember these four as I have explained it to you: listed debt securities, then have accepted trade receivables, then rental incomes and equipment leases. And then minimum track record requirements. To qualify for securitization, originators must demonstrate a minimum operating experience of 3 years. Remember, the originators should have a minimum experience, right? And that has been specifically established as 3 years here, so that it gives an idea. You will be in a better position to manage all these assets or manage the securitized debt instruments or be a part of the creation of securitization or securitized instruments, right? Securitization process. So remember this thing: to qualify for securitization, originators must demonstrate a minimum operating experience of 3 years. Minimum operating experience. Now this will ensure that only established entities in the market, they participate in the process of securitization, not the pressures, right? So you should have some experience of managing such kind of instruments and participating in the process. So these were the guidelines by SEBI. We have seen what is REITs, what is InvITs, and then I have explained you the guidelines for REITs and InvITs. The interest rate swap we have seen, and the interest rate swap application in the REITs and InvITs. Then we have seen these guidelines for the securitization process. So these were some of the guidelines which I talked about in the current affairs class held today. I hope all of this is clear to you. Even if you have any doubt, you can always ask me. Thank you so much. I hope this becomes useful for you. Have a great day. See you in the next session at 10 a.m. tomorrow, the next current affairs question and answer format. Okay. Thank you so much. Have a good day.